Gene, I'll start with you. I was reading your notes. The market's down today, so you're going to look a little better today in terms of your past appearances. You still don't really like stocks. You think things probably could still happen, that the trade war could reemerge. You never know what President Trump's going to do. But how long have you been not friendly towards stocks? The S&P's, what, 30, where is it now? It's 35th, something like that. We're at 2,700, were you recommending no investments? Or honestly, when did you get negative?
Thank you, Joey. And hey, Joe, thank you. Happy Veterans Day. Clearly, throughout the year, we talked about this. We've been cautiously optimistic. We've been looking to take the right bets in our portfolios. Just recently, we've turned cautious. Yes, some of the downside risks are starting to fade, but there's still 3 or 4 clear risks that we're watching carefully. You alluded to them earlier. The trade war, yes, it's on pause, but President Trump can easily retweet something, and all of a sudden, things get reversed. We saw this on Friday. We were a little surprised that markets didn't reverse on the news. Second of all, valuations are pretty high. 17.4 times forward earnings, well above the 5-year average. This is pricing in absolute market perfection. You look at third quarter earnings, down 2.4% year over year. Even this year, first, annual earnings up 0.1%. This year's market move is really pure price multiple movement higher. Third of all, you talked about this earlier with your earlier guests. We really believe the political uncertainty. You have, Michael Bloomberg jumping in. This definitely benefits Warren as a candidate. We'll see how markets like that go on the go-forward basis. And our last point is bond yields. Bond yields have jumped up 40 basis points over the last month. Think about if you're a foreign investor. A lot of foreign investors are buying U.S. Treasuries. Now their bond prices are lower. If the dollar has like a 5% decline, all of a sudden these investors have a 2-year loss in yield. So we're watching this very carefully. Again, we're not like Polly Purehearts and complaining about the markets being very negative. But all we're saying is be very, very cautious in this environment right now.
Where are you, Jason? You think we go? Let's call 3,000 just the average of where we are. We're going above that or below that in the near term, in an intermediate term, or the next 6 months.
Well, I think just looking at the fundamentals and looking at the momentum in the market, I think the safer bet is that we're going higher. I mean, we're certainly not short-term traders at Albion. We're long-term investors, so we prefer to take a little bit of a different view on where it's going to go versus 3 to 6 months. But what we heard is a list of reasons not to own stocks a moment ago, and I would argue that there's a lot of reasons to own stocks, especially if you're a long-term investor. I mean, valuations are not that expensive relative to interest rates and inflation. We have earnings estimates that have now come down to a lot more reasonable hurdle in our view. I think Q4 is expected to be negative slightly again next year, 8-9%. We think that's something that can be achieved by the market. Meanwhile, trade's been kind of put on the back burner. Companies are telling us the economy is doing okay, and if you look at the fundamental underpinnings of this economy, we think that we're still in a 2 to 2.5% GDP environment. So those are all good reasons, I think, to be owners of good companies for the longer term, and that's what we're telling our clients.
If earnings are going to grow 8% next year, 16.5, 17 times seems really cheap. Are earnings going to come down from 8%? Or are we just going to see the multiple expand as the market believes it?
It's a great question, and I agree they are cheap relative to that expectation. And in truth, what typically happens is the earnings start high and they come down, analysts revise lower, and of course that hurdle gets a little bit easier to beat, and it's expectations or results relative to expectations that's really going to drive stocks. So I think that's a good setup for next year. I'm not sure whether or not we're going to beat that 8 or 9% bogey, but I think that it's probably in the ballpark, and I think it's supportive to equities as we look out over the near term.
So go ahead, Gene.
Yeah. So, I mean, we look at earnings in 8-9% next year. They are a little elevated. You look at, obviously, there will be some inflationary pressures. Look at wages are rising. There are concerns. So we do believe that wages will push earnings down. Margins will be declining. So we do expect analysts to revise next year's earnings. Right now, 8-9%. We could see them being revised down into 6-5% pretty easily.